Our next guest says this year's banking crisis is not over yet, though it's inappropriate to compare it right now, at least to the 2008 meltdown. Joining us right now, Simon Johnson, professor at MIT, former chief economist at the IMF. He's the co-author of the new book, Power and Progress, Our 1,000-Year Struggle Over Technology and Prosperity. Good morning to you. So not 2008, but what is it then?
Well, we're about to find out, I think, when commercial real estate goes through the presumed downturn. It might have some resemblance to the 1980s, the savings and loans crisis, where relatively small financial institutions cause larger systemic problems. Of course, that's why we're supposed to have prompt corrective action. But with Silicon Valley Bank and with First Republic, we didn't. So there's a lot of tension there.
We didn't. So what would have been the right decision in your mind?
Well, obviously, earlier intervention by the supervisors addressing interest rate risk. This is very prominent after Silicon Valley Bank. They let it slide, and that was based on the relaxation of regulation supervision that came out of the decision of Congress and the guidance that came from the very top of the Fed after 2018.
How concerned are you about either other regional banks or community banks going under or becoming insolvent or being resolved, if you will, in the context of whatever you think the problems with commercial real estate office and everything else may turn out to be?
I don't like to talk about specific institutions, but let me speak broadly. Sure, I'm very concerned. I think particularly because we don't have a transaction account guarantee. There's no protection of essential business payroll accounts. So what's happening among the people I know is that they're starting to shift their footing, open an account with one of the largest banks. Maybe we can call them too big to fail now. And sort of hedging against there being further disruption in the smaller bank sector. I think the flightiness of deposits has increased substantially. Nobody quite knows who's going to take what hit when the next bank is in the line of fire.
We were talking to another guest earlier today, and I was arguing that the digitization of all of this has made the flight of deposits a risk that I think was unimaginable before. And how do you effectively assure against that, except to effectively force people to keep a remarkable amount of deposits basically on hand at all times, which would actually have a deleterious effect on the rest of the economy in terms of credit?
Yes, absolutely. I think the digitization, we learned this, has sped everything up. But the underlying vulnerabilities are classic vulnerabilities, the kinds of risks that Silicon Valley.
So if you were to guarantee the deposits, you think that solves the problem?
For transaction accounts, not for all deposits, but for transaction accounts for business, then business doesn't have to say, oh, I might not be able to make payroll on Friday, let me put my money with someone else.
Money is a fungible thing. Don't you worry that people will sort of use these accounts in unusual ways in terms of claiming something's a payroll account to keep it insured? It's not an exact science and becomes very difficult to police.
That's absolutely true, but the FDIC does keep track of transaction accounts already. In 2008, they had an effective program that they put in place. They had one during the pandemic. You make it a temporary program, Andrew. You don't make it forever. And I think that without that kind of safety net, the business deposits are going to fly at first into trouble.
Are you a long-term fan of having the number of banks we have in this country? Is that a good thing? Is that a bad thing?
I'm agnostic on the number of banks, but I like competition. I think competition is very good, very healthy. I think the problem is when some of the smaller banks go all in on a particular geography of commercial real estate, then there's going to be a reckoning.
Where do you weigh in just in terms of the regulatory oversight? Obviously, the first problem would be with the executives at the bank, but should the Fed have picked up on this sooner? Can we guarantee they're going to be watching for this problem more closely next time? It feels like we're always regulating for the last crisis, not the next.
This was a massive regulatory and supervisory failure. Maybe a wake-up call, so that might be useful, but the Dodd-Frank created a vice chair for regulation and supervision at the Fed to elevate supervision and regulation within the Fed ecosystem. So the legal responsibility was there, the political support was there, and what did the relevant people do? They backed away from regulating and supervising these mid-sized regional banks. And now we have a major problem. So that's a lesson learned.
From what we've heard, though, part of that was the messaging that was coming from Congress and other places saying, have a lighter touch, have a lighter regulatory touch. How do you keep that from happening, especially when you had Barney Frank himself lobbying to have these rules watered down because he was sitting on the boards of one of these banks?
There is always a political cycle around regulation and supervision, and we just saw that in action. The job of the Fed is to be professional, to be objective, and to say, look, there's a limit to how far we're going to go responsibly, particularly given the fact that interest rates are now low and we're going to have to raise at some point. They did say that for a long time, but there was a disconnect between the monetary policy part of the brain and the supervisory part of the brain. Absolutely. And that needs to be fixed by the Fed.
I have a separate policy question. If you do believe that there's a number of banks that are going to run into trouble as a function of commercial real estate falling and where interest rates are, what would you do to get ahead of it now? Would you start resolving banks in advance?
I would put the transaction account guarantee in place. I think the banks should be allowed to fail. I think having any part of the economy be too big or too complex or too connected to fail is a problem, because that will lead to incentive issues, that will lead to taking more risks. That's very inappropriate and not suitable. With the transaction account guarantee, I think we would weather the commercial real estate storm better.
You layer AI into all of this?
Deep fakes, identity theft. That is going to be a very pointy end of how we experience AI, particularly in finance. We already have a big problem with identity theft.
And
it's going to get much more
dramatic. The idea that someone's going to fake the phone number, the voice of the CEO, that's going to leave a voicemail for the CFO and say, please transfer X amount of money over here, and they're going to actually do it.
If I send you an email, Andrew, that says,
yes,
please call me, and I give you my cell phone number, you should not call me and rely on recognizing my voice to know that it's me. You should ask me for unique identifying information that only you and I know, something that was never digitized, like when did we last see each other, what did I have at lunch when we had lunch. That's what you need to assure identity. Otherwise, it's all going to be, people are going to have a lot of identity theft, and they're going to lose seriously, including on the financial side, and that's not currently been regulated.